China's semiconductor revolution. In 2023, China invested $2.6 billion in advanced lithography equipment from Dutch manufacturer ASML to boost its domestic chip industry. This technological path was dramatically altered when the United States pressured the Dutch government to revoke export licenses for ASML's deep ultraviolet (DUV) machines, effectively disabling $15 billion worth of equipment already in China by cutting off maintenance, updates, and support. Rather than accepting this setback, China launched an aggressive campaign for semiconductor independence. Beginning quietly in 2022, the Chinese government channeled over $75 billion through state-backed investment funds into chip design, wafer production, and lithography technology, while simultaneously recruiting more than 50,000 engineers from companies like Huawei and SMIC, as well as returning experts from Silicon Valley. The results have been remarkable. In just 3 years, China built an almost fully localized chip supply chain, with factories now operating with 60 to 70% domestically made equipment and local laboratories developing both chips and design software entirely within China. Don't miss our upcoming analysis on how this tech revolution will affect global markets and your investments. Subscribe to our channel now for exclusive insights and breaking news on the semiconductor industry's future. Breaking free from foreign dependencies. China's approach to semiconductor independence has surprised industry experts worldwide. Instead of pursuing the extremely expensive extreme ultraviolet (EUV) technology from ASML, machines costing $200 million each, China focused on maximizing existing DUV technology. Shenzhen-based company Sicar claims to have developed proprietary DUV lithography methods capable of producing chips smaller than 7 nanometers, a claim substantiated when Huawei released its Mate 60 Pro smartphone featuring a 7 nanometers chip manufactured entirely with band technology. This development stunned the global tech community, who had assumed such production would be impossible without Western equipment. Even more impressive, SMIC, Semiconductor Manufacturing International Corporation, has entered testing stages for 5 nanometers chips and aims to advance toward 3 nanometers using AI-powered yield optimization and quad patterning techniques. What most analysts predicted would take a decade has been achieved in just a few years, suggesting China isn't merely catching up but potentially pioneering alternative approaches that could eventually surpass Western methods in certain applications. Economic consequences. The semiconductor standoff has already triggered significant economic repercussions beyond the tech sector. When China reduced purchases from TSMC and ASML, the Dutch company saw its revenue plunge by 27% in Q4 2024, delivering a direct hit to Europe's technology ecosystem. The conflict has expanded into financial markets as China begins selling U.S. government bonds and reducing investments in American tech stocks like Apple and Nvidia. This financial dimension threatens to transform a chip war into a currency war with potential consequences for mortgage rates, tech valuations, and retirement funds worldwide. Chinese chip manufacturer SMIC now controls nearly 20% of the global market, quadrupling its 2020 position, demonstrating China's determination not just to participate in the semiconductor industry but to fundamentally reshape it according to its own strategic vision and technological capabilities. The tariff war escalates. What began as targeted technology restrictions quickly escalated into a comprehensive trade conflict. The Trump administration implemented a series of increasingly aggressive tariffs on Chinese goods, starting with 10% duties that eventually rose to 34%, with threats to push rates as high as 104%. Such extreme tariff levels would effectively double the price of imported Chinese products. A $20 toy would cost $40, a $400 smartphone would jump to $800, and vehicle prices could increase by $6,000 to $12,000. China responded with matching 34% tariffs on American goods, particularly targeting agricultural products like soybeans, corn, and processed foods. More strategically, China restricted exports of rare earth materials, elements crucial for manufacturing advanced technology including electric vehicle batteries, military radar systems, semiconductors, and night vision devices. With control over 90% of the global supply of these critical materials, China's decision to require special licenses for American companies represents a powerful leverage point in the ongoing negotiations. Global market impact. Financial markets reacted swiftly to the escalating trade tensions. Hong Kong's Hang Seng Index plunged over 13%, its sharpest drop in nearly 3 decades, while the Shanghai Composite tumbled more than 7%, erasing $500 billion in market value overnight. American markets weren't immune, dropping between 10 to 15% within days as investors rushed towards safer assets. Chinese investment in the United States has collapsed from $46 billion in 2016 to just $2.3 billion in 2024, with a complete freeze on new investments recently announced. This capital withdrawal isn't random but represents a strategic reallocation toward regions China considers more politically and economically advantageous for its long-term goals. American businesses faced immediate financial challenges. Companies reported substantial losses, were forced to take emergency loans at interest rates nearly double normal levels, and watched as approximately $120 billion was withdrawn from U.S. stock ETFs in just 3 months, creating liquidity challenges across multiple sectors. Impact on American consumers. American households are feeling the direct effects of the trade war through higher prices on everyday items. Each household faces approximately $1,950 in additional annual costs as tariffs drive up prices on products ranging from electronics to groceries. Essential items like bananas from Costa Rica and Ecuador, 10% tariff, shrimp from Indonesia, 32% tariff, and Vietnam, 46% tariff, Norwegian salmon, 16% tariff, and coffee from Brazil and Ethiopia, 10% tariff, have all become more expensive. While some products saw gradual price increases as stores depleted existing inventory, the cumulative effect has been significant, particularly for working-class Americans and retirees living on fixed incomes. The financial pressure comes at a time when inflation remains elevated at 3.6%, meaning households are caught between rising prices and stagnant wages, effectively reducing purchasing power and quality of life for millions of Americans. Widening global tensions. The trade conflict has expanded beyond bilateral U.S. China relations to affect America's traditional allies. After facing heavy tariffs on steel, aluminum, and automotive exports, Canada threatened to redirect its oil exports away from American refineries, with Canada currently supplying approximately 4 million barrels of oil daily to the U.S. Such a redirection would create significant supply challenges and potentially increase gasoline prices by 20 to 40 cents per gallon, particularly in New England. Canadian officials have made unprecedented statements about the deteriorating relationship, with Foreign Minister Melanie Joly declaring that the relationship between the U.S. and Canada will never be the same. The European Union initially called for global resistance to American tariff policies before pivoting toward a negotiation stance, offering zero tariffs for industrial goods to prevent further economic damage. Germany strongly defended its green energy investments when criticized by American officials, viewing the disagreement not as a simple policy difference but as a fundamental clash of values regarding sustainability and environmental responsibility. Manufacturing and jobs at risk. The cascading effects of trade tensions have begun disrupting major industrial projects across the United States. Intel's planned chip factories in Ohio were suspended. Battery and robotics projects faced delays or cancellation. And 62% of American manufacturers reported severe financial shortages that prevented planned expansions. These disruptions threaten millions of jobs, particularly in manufacturing regions already struggling with economic challenges. Automotive manufacturers and technology companies face difficult choices: reduce production, raise prices, or absorb costs that damage their competitive position. The agricultural sector has been especially vocal about the impact of retaliatory tariffs reducing access to Chinese markets. As one farmer stated, "I don't know where it ends. I hope it ends soon. I hope it ends with us willing to be good partners with these countries around the world." This sentiment reflects growing concerns that short-term trade tactics could cause long-term structural damage to American export industries that have spent decades developing international relationships. The debt challenge. As foreign capital withdraws from American markets, companies have increasingly turned to higher-cost financing alternatives. Junk bonds with yields reaching 9.6%, double the rates from just 2 years earlier, have become necessary for businesses needing capital. A looming debt wall of $4.1 trillion in business obligations maturing by 2026 creates additional pressure as refinancing becomes more expensive across all sectors. These financial constraints compound the challenges of the trade war, creating conditions where businesses face higher input costs from tariffs simultaneously with higher capital costs from changing investment patterns. The combination threatens business expansion, job creation, and long-term economic growth precisely when adaptation and innovation are most needed to address changing global trade patterns. The future of global trade. The U.S. China trade conflict represents more than disagreements over tariffs. It signals a fundamental reshaping of the global economic order established over the past 40 years. as China pursues technological self-sufficiency and develops alternative supply chains. The model of globalized production that defined the early 21st century faces its greatest challenge. The question remains whether this confrontation will result in two separate technological ecosystems or whether economic realities will eventually force a return to more integrated trade relationships. What's clear is that the consequences extend far beyond immediate headlines, affecting everything from consumer prices to national security considerations. For ordinary people caught in this economic transformation, the immediate future includes higher costs, economic uncertainty, and potential job disruptions as businesses adapt to rapidly changing circumstances. As one analyst noted, this trade conflict represents shock therapy that could kill the patient if not carefully managed by policymakers on both sides who understand the delicate interconnections of the global economy.